All right, as we mentioned, the tone of the markets is negative. Let's bring in Sahak Manuelian, Managing Director and Head of Equity Trading at Wedbush. And Sahak, Home Depot didn't really give us much to cheer about. Not only did sales come in worse than feared, they're also cutting their sales forecast. I don't know if it's emblematic of what we've heard for most of earnings season now that it's behind us, but certainly not a picture of health for the consumer.
Hey, Amber. Yeah, I don't believe it's emblematic of what we've been hearing for most of this earnings season. Quite frankly, I think the earnings season has been going rather well. We've seen forward estimates and guidances being revised higher. We think the earnings recession has really been taking place since early 22. And actually now going forward, we expect to see margins start to improve. And we feel like we've been seeing margins improving as there's been a multiple of various tailwinds for stocks going forward. Various initiatives companies have taken, but we actually think the Q1 earnings season is going pretty well and actually better than maybe feared. As we come towards the end of it, though, sure, your comments are not lost upon me. Home Depot having a tough morning today, stocks trading down, and I think most concerning is the commentary about the weakening demand in general, which probably will put more focus on Target and Walmart, which are coming up the next couple days here.
You know, thinking about your points on earnings, it's messy, right? There's something for the bears to chew on. There's something for the bulls to chew on. Inflation, it's the same sort of thing, right? You could view inflation as coming down, or you could view it as sticky, depending on what components you decide to strip out. And I think that debate is playing out real time in the markets. We've basically been going nowhere for a year. There's been some volatility in between, but fairly range bound. Do you see any signs that we're building to something, whether it's a breakout or a breakdown?
Very tough question, Amber. But the way we're thinking about this is, it's really a fundamental story for companies versus the macro backdrop, and that macro backdrop is exactly what you alluded to, the inflation situation. And if we look at the U.S., for example, CPI and PPI both coming in incrementally positive a week and a half ago. Well, then we come in last Friday and we've got Michigan inflation expectations a little bit higher. That's concerning. And then overseas, Japan and Sweden yesterday had some pretty dovish prints from their CPI and PPI prints, respectively. Canada this morning, a little bit higher than expected. So, yeah, a lot of cross currents to your point. I think that what's important is companies being able to deal with inflation, I think have been gearing themselves to deal with the stickiness of inflation. And to that end, it's really been about companies taking various actions to help. Cost cutting, we've seen a lot of layoffs. XF pressures have been subsiding. The dollar remarkably down versus where we were last September or last fall. Yields have been rolling over, mainly from the banking crisis from a month and a half ago, but we're down some 100 basis points on the 2-year and maybe 50 basis points on the 10-year. That's helping some normalization of supply chains, et cetera. So the fundamental backdrop getting better, and it's really companies going up against this macro backdrop, which is certainly proving to be much stickier than maybe many investors thought initially.
So then let's look at the leaders of the rally. It's been, back to those FANG stocks. It's working again today. And, certainly over the past year when the FANGs are working, the overall S&P 500 is working as well. That hasn't been the case for the month of May. The FANGs are hitting kind of new highs, definitely 52-week highs, and the S&P is not. Why the divergence? Would you chase that, the momentum in FANGs higher?
Yeah, funny enough, these FANG-type names are actually starting to feel much more like the defensive issues right now. And so this year has really been, the flight from quality trade from last year is kind of diverged into technology stocks outperforming, telecom, namely communication services, outperforming. And then we've seen consumer discretionary outperforming, while defensives have really been trailing the broader market and have been underperforming. And then the financials and energy both getting hit pretty hard. I think that going forward in the playbook, looking into the second half of 23, will be much more, again, really stock selection as opposed to going out and chasing different sectors within the S&P 500.
And so when you talk about stock selection, what are some of the areas that you like?
So focusing on healthcare, within healthcare, we like biotech here, not a widely popular call. However, if one looks at the mid-cap biotech and therapeutics complex, it's been a relative underperformer for the better part of 18 months here. More recently, year to date here, we've now had 8 M&A deals. We've seen some bankruptcies, which has been kind of part of this cleansing out process that I think the whole group needs. And so we've recently seen some decent news data and stocks moving higher on that news data. And I think that as sentiment has been overly negative for maybe a little bit too long, getting long in the tooth, I think that some of these stocks into the second half actually have some pretty decent setups here as the fundamentals start to catch up to these stories.